everybody. What an amazing, amazing panel. It's going to get followed up again by one of my other favorite topics, vaults and RWAs. And this is another very special panel of a great mix of folks, including Victor Jung, the head of digital assets from Hamilton Lane. We have Sun Raghupathi, the CEO of Veda, Tim Stoddart, Chief Revenue Officer of Raze, and Michal Benedykcinski from the CCO of Uniform Labs. So let's welcome them on up, everybody. Let's give them a large round of applause. And let's talk about vaults.
Awesome. Well, really great act to follow on the prior panel. Thank you very much, Redstone, for having us here, and super thrilled to dive all into the vaults topic of today. I think we have a pretty great representation on this panel from some of the blue chip asset issuers, some of the critical infrastructure providers, and then very important distributors, actors on this panel as well. So maybe very quickly, just so that everyone knows who is who and kind of what is the general mandate of each organization, would love for all the panelists to give a brief introduction, and then we'll dive into some of the topics of the day. Very briefly on myself, my name is Michal, Chief Commercial Officer at Uniform Labs, where we are building multi-liquid. This is a secondary liquidity rails for blue chip RWAs. So the topic of the panel today, very near and dear to our hearts. And so we are excited to dive right in. Maybe starting with Victor.
Hi, thank you. Victor Jung, heading digital assets at Hamilton Lane. For those of you who don't know what we do, we are a private markets only investment manager listed in NASDAQ, managing 1 trillion AUM AUA. And our mandate is to provide cheaper, better, faster, tokenized private markets product to the audience that may want it in such format. Thank you.
Hey everyone, I'm Sun, co-founder and CEO of Veda. We're a vault infrastructure platform, 1 billion in TVL. I feel silly saying that after following Victor here, but we power yield products for Kraken, WAP, EtherFi, and many others. In my opinion, RWAs are the future of vaults, and vaults are the future of RWAs, so really excited to be chatting with my fellow panelists.
Hello, I'm Tim, and I'm a co-founder and the Chief Commercial Officer of Raze Finance. Raze Finance is a fintech, and we're a software company that provides vault as a service software. That software has to be operated by legal entities that are operating compliantly, and we also operate our own entity that uses our software and operates it compliantly so that others can see how it's actually done. For my background, I'll be real quick. I took and passed the Series 7 with a number 2 pencil and an eraser.
Great intros. Thank you. I maybe wanted to start off by just diving into some of the potential bottlenecks that we're still seeing for this to truly take hold and become really the main point of distribution of tokenized assets. So from your vantage points, I think where we are today, at least, just kind of giving context for the audience, we're really moving past the why tokenize this question into now more what are some of the challenges and bottlenecks we can tackle to truly kind of unlock the potential here. And so we'd love for each and every one of you to chat briefly from your vantage point, what is kind of like the biggest bottleneck that you're trying to solve for and you're seeing out there, where it's infrastructure, regulation, asset selection, even institutional appetite. Would love to get some of that color first, starting with Sun.
Great. Yeah, so I think it's very clear that, tokenization, the benefit of this is distribution, right? The financial system today has been very closed. It's difficult for the people who really need access to good assets to get those assets. And this is kind of the point of crypto, right? It's making better financial products and distributing them globally. I think there's a lot of bottlenecks we're seeing today for why we haven't seen true global distribution of tokenized assets. One of them is this weird phenomena where tokenized versions of things like money market funds actually turn out to be less accessible than the traditional counterparts, right? Like retail can generally get exposure in the US to things like money market funds, but the vast majority of tokenized versions of these things are only accessible to institutional investors. So like, why is that? I think that's extremely bizarre, right? What you do have is a lot of the composability benefits, right? The efficiency benefits of these products, and yet they're not accessible. So I think there's more work to be done on tokenization structure. In my view, like the wrapper model for RWAs is maybe not optimal. What you should be doing is integrating blockchain properties directly into tokenized funds, so you can preserve sort of the the distribution and accessibility properties of the underlying funds, as opposed to layering more eligibility requirements on top. I also think the form factor is not there, and this is really where vaults come into play. If you think about where these RWA products should be distributed, it's really through fintechs, right? To users who might otherwise not be able to access these products through their own traditional rails. And so fintechs, they want these products. At least from my vantage point, we're seeing demand for RWAs to be distributed through vaults. And so this becomes an interesting technical question and an interesting regulatory question on how do you take vaults that are distributed to retail through fintechs, backed by RWAs and tokenized funds.
And maybe just riffing a little bit on that point, because as you rightly pointed out, already plenty of access to potential exposure to money market funds, and that was kind of that phase wave of what got tokenized. But plenty of other super interesting asset classes, private credit, private equity, commodities, still unaccounted for today. Just curious to hear, Victor, from the perspective of what you are looking at in terms of the different assets to bring here on chain. How are you kind of pitching this internally even?
Yeah, I think that we need a little bit more of context, but to begin with, I think vaults, which is a very interesting trend, from our point of view, we see it as what ETFs did to the stock market. You can wrap anything under an ETF. ETF is not an asset class. It's a wrapper, right? But ETFs are, they take more than 60% of the trading volume in an exchange, right? So they are compliant, they're secured, they've been tested, and they're seamless, they're easy to do. Vaults are not there yet, but vaults should be at that level, because vaults could be non-compliant, could be compliant, could be non-KYC AML, could be KYC AML. There are a lot of benefits, and you need to know who the audience is. Now, we've seen a spike of interest from the DeFi world, and I attribute it to one of my earlier panels last month. Is post 1010, right? The open interest pre-1010, October 10th, and post has never recovered. But then this was what gave birth to the three trends that I call it the three R's. One is regression to re-centralization, right? The second one is the return of the regulated institutions. Right now you see Fidelity, Morgan Stanley, everybody is now from ETFs to digital assets. They're becoming more and more native. And last but not least, it links to and summarizes to something called RWA, but it's also real free cash flow, real world assets. So post 1010, people recognize that real world assets actually generate that yield and value. It's real, right? They can touch it, they can feel it, and that's finance, that's capital market risk-free rate. Now, if private markets can provide an extra, right, and can be vaulted, then this is what the audience is slowly getting educated and learning. And now, if you look at the trend of RWA, there's everything. But if you look at the growth over the last 4 years in everything from tokenized commodities, gold, and whatnot, they've all been like a hockey stick. Now, if you look at two specific asset classes which are very trendy these days, one being tokenized stocks, right? If you look at the growth achieved, it's fantastic from inception, from the last 4 years. But if you look at how much of that growth has been achieved post 1010, it's 80%. It's because it's real. Let's park aside the nativeness, the SPVs, but they want access to that return, right? Governance, stake, that's separate. They want access to that extra return. Now, if you look at another RWA asset that many would not agree, but they're more real than others, it's prediction markets. So prediction markets, you cannot do it on a TVL. You have to look at it in the transaction volume. Transaction volume were like sub 10 to billions now. And 90% of the growth has been achieved post 1010. So you could tell the audience and the user and the buyers are looking for that extra yield and extra return that is more predictable. But now, for us as issuers and listed entities that have been, more than over 15 years managing big sums, vaults lack a track record history of. The perception of vaults are too permissionless, and you come to a regulated player that gets audited, that is listed, with a concept called permissionless, non-KYC AML. This could affect headline risks or even bigger than legal risks. So a lot of the vaults and everything that's happening here, there's a lot of good use case collateral, because it makes everything cheaper, better, faster. But if something happens, right? DeFi firms 2021, DeFi firms now, like 2/3 are gone, the champions. There are very few who are alive, so I cannot also blame our legal and compliance people for the stance they take, because you've built a cathedral, and in one day you could be wiped out and be forgotten and maybe subpoenaed, who knows? So my take is, look, we need to understand this technology, the blockchain technology. There's a lot of benefits that could provide, cheaper, better, faster, collateral mobility, NAVs. But our ask is, is it compliant enough so we can just bet on this and make sure, let's leave the technology part, but also on the future, are we comfortable enough to make a bet? The role of the service providers, we need to work together in order for us to freely open and let our assets be available to that universe.
Thank you.
I just want to follow that quickly, because there's a couple really interesting things there. I think the first thing that I want to comment on is this idea of permissionless, which in my opinion is totally incompatible with RWAs. And it is frankly an unsolvable problem, which if you asked me 4 or 5 years ago, when I think DeFi was very, very different, there was this vision of we're going to bring everyone directly on chain. They're going to get their own wallet, manage their own keys. We shouldn't have any KYC AML. Everyone should be free to use everything. I would have been disappointed 4 or 5 years ago. But DeFi itself is evolving now from this thing that is being marketed directly to consumers, like, hey, come use DeFi, to being more of a back end, right, for fintech companies and asset managers who want to distribute their products, grow their user base. And all of that is regulated, right? This is the beauty of it. It just so happens that DeFi is also moving to an era where most of the users coming on chain are actually going to be KYC'd through the fintech platforms that they use. And so this is a really great, I think, time for RWAs to actually be able to reach these users. The technology we're building, maybe it was originally intended for permissionless use, but it's really just a more efficient and distributable form factor for these products. So that's one thing. I think permissionlessness is mostly dead, unfortunately. The second thing that's really interesting is not just 1010, but the wave of exploits that we've seen in DeFi, right? There's been a number of 9-figure exploits over the last 6 months. And the result of this is that fintechs still want the same UX, right, that you get from a DeFi yield product. They want instant subscriptions and redemptions through stablecoins, 24/7 liquidity, right, higher yields than what you might get in the traditional markets. But they are looking for alternative, safer sources, and they're looking at RWAs. So there's a really, really opportune moment. I think DeFi is also just undergoing a change, and so we're just going to see a merge of these two worlds.
Maybe just steering this a little bit towards the direction of kind of the underlying theme of kind of compliance and some of the elements that a lot of the risk committees, even those that are here in the room today, look out for. Particularly curious from your perspective, Tim and Raze, especially the type of assets that you guys engage with and enable on your infrastructure. What is some of the kind of pitch to those risk counterparties, allocators, and underwriters, and how do you engage beyond just provisioning the infrastructure rails?
Thanks, that's a great question. So we are a little bit different in what we do. We're kind of niched down. You don't come to raise capital using magic pixie dust. It doesn't work that way. Raising capital has been the same as it's been since I got in this business a few years ago. And that's the hard part. So what we're actually doing is we're trying to do a couple of concurrent things that are easy enough to do by themselves, but when you do them together, it gets kind of interesting. So issuing private placement securities, okay, nobody's going to get an award for doing that better than they did a year ago and 10 years ago. Same thing. Now let's put a security on blockchain, or let's put anything on blockchain. Let's tokenize it. That also is pretty much easy to do these days and getting a lot easier every day. But you do all these things together, and you need to come out with something that is absolutely compliant, legal, and all of that, just as it was before. And quite frankly, I look at every project and every asset that we look at that we would consider putting into a vault, and it's like, well, why wouldn't I just go and buy it right now? Why can't I buy it directly? Why do I have to go through a vault? And in many cases, the answer is, well, you can't buy these, originated bunker fuel invoices from this company in Singapore that happens to know a little bit more about that than we do. So, that's access. And, having a sponsor run the vault and bring the buy side in, as well as the assets. Now, they're not going to ask me about the quality assets. They're their own assets. They're just using our infrastructure. So we now require anyone coming to use our vault software and to help set up a vault for them is they have to put 20% of the capital in to the portfolio. Otherwise, no one in this room would touch it, right? So everything we do really just has to stay absolutely working in the real world. I'm glad I don't have to teach what tokenization is and why one would do it these days. I used to say you could tokenize anything. I could even tokenize my grandmother, but that probably wouldn't work out well. And at any rate, so as far as the asset side, I still need a credit analyst for looking at these various trade finance assets. And I didn't get rid of that, although it's a little cheaper. But I also need now a smart contract auditor. So one of the things that we constantly run into is, isn't this all supposed to lower costs? Well, yeah, eventually at scale. But it seems like in the early days for us, because we're not a $1 trillion manager, we're not a $100 million, billion. We're a little less than that. But so again, it comes access. If you think about this, investing in commodities other than precious metals, gold, coins, things like that, when have you really ever invested in true commodities? You've been basically buying a fund or an ETF, a structure that was really getting commodities futures and using for totally different reasons than spot exposure. So actually, there's a greater interest in commodities and precious, and also now base metals, critical metals, all that. Everyone wants in on that now. So tokenization in the metals world is actually really, really is part of the space that got me into this. But at the end of the day, it's an asset, and if you're going to invest in it, there's two things you're going to consider. Diligence the asset, why would I even expose my capital to it? And then what's the most efficient way to get in and get out of it?
Thank you. So what I think I also heard from all the panelists today is how a lot of the DeFi rails, originally permissionless, have kind of evolved, especially to kind of capture and become now the canvas for next wave of type of assets that are coming online. Curious to hear your on-the-ground take on what does kind of the compliant DeFi look like. And maybe starting here with Victor, you had this great quote on a Proof of Talk podcast where you said, DeFi can make an existing offering better while remaining compliant. Really great that Hamilton Lane Compliance gave you a heads up for that. But for the actual practical implementation, what does compliant DeFi look like? And if you could just also let us inside into kind of the Hamilton Lane, like what is that kind of internal dialogue and conversation to get you to that point?
Sure. Compliant DeFi could look very different if you ask a DeFi institution versus us. It's the same word, but it will be interpreted very differently. I see DeFi, just in this more of a personal thing, as a most libertarian state for securities, and I see securities as the most conservative state for the DeFi world. Now, when the issuer is providing the product, and again, I mentioned this before, when you say DeFi permissionless, it means it's free. And the premises and everything that is finance, you need KYC, AML, you need fund registrations, you need approvals, and without the regulations approval, you cannot issue or launch a fund, right? I think a lot of the challenge that we have, because the execution we're still not there, is getting people familiar with the concept. So, for example, if you've never touched fire in your life and you're being told that fire is hot, that's very different to really when you touch it or tasting vanilla. How do you explain the benefits of DeFi when? How do you explain that USDC exists on different chains, right? How do you explain bridging? How do you explain that a USDC on the different chains is not like a Hong Kong dollar and a US dollar, right? This is the same dollar. And at the end of the day, it's a lack of time that we all have because we're very busy on the day-to-day. Once everybody gets to open up a wallet and send a USDT or USDC from the other side of the world to the other side of the world in less than a minute and at a fraction of the cost, then they are more willing to understand what the benefits of the DeFi world is. That's why I don't use the word DeFi too much. I just say native permissioned. Like you're nodding because it's the same thing, but it just sounds cooler from a traditional standpoint. So I always tell all of our partners, they say, hey, we're DeFi permissionless because that's the coolest thing. That's religion, right? But hey, if you want to work with us, you cannot say DeFi permissionless. I mean, we need to say, hey, native permissioned, and that means we're not lying. You can have smart contracts, geofencing capabilities. So using the best of the DeFi world and applying to securities is the explanation that you have to do, but that needs to come with experience and just having 30, 45 minutes to open up a wallet and just trading with a MetaMask and whatnot. But the perceived risk is much bigger than the real risk in my view. But it comes with a price when you work on a traditional financial institution. We're very willing to embrace new technology, but it requires time, and a lot of it's just education. I think that's a bottleneck for us. Yeah.
Great points. And I think what I'm also picking up is this tension between institutional grade and institutional ready. Specifically, I think in the context of the core primitive here today being the vaults, curious to hear Sun's and Tim's take on what do you think, are we kind of outpacing the asset class, being the tokenized assets that are coming on chain with our infrastructure capabilities, or they're really kind of working in tandem to unlock this? Because a lot of talk, you really talk to pretty much anyone these days in Wall Street, they're all thinking or researching a variety of different vaults and vault strategies. But for the actual implementation to get us essentially off zero in a meaningful way, what would it take from kind of the vantage point of a vault infrastructure provider?
Sure, I'll start with that one. It's going to constantly be, the foot race where the tortoise is ahead and then the hare's ahead, and it goes back and forth because right now we need the technology to actually incent the sell side to be there so the buy side might actually show up. Because if there's no buy side, there's going to be no people in this room eventually. Well, there will be, but they shouldn't. So I would look at everything from how do you actually connect to that. Right now there's not enough robustness, there's not enough, herein lies the big problem. Everyone in this room is well aware of what's going on. What about the people that aren't in this room? There's a lot of money out there. They're not going to go and self-custody first. That's the absolute antithesis of where they come from, right? So I think you have to kind of, you got to do a little build it and they'll come, even though that's not the reason to. But if you have the reason to do this, you got to have some patience. We're 4 years old and my God, we're still here and it feels like it's been 12 years. But it's going to happen. It's inevitable. There's nobody making the argument this is a flash in the pan and we're all going back to, we actually did have T+0 settlement and T+1 settlement back in the 1800s. We went to T+5 in 68. And that was the standard regular way. Anyway, I digress.
Yeah, so I want to dovetail that with the compliance question, because I think there's the sort of obvious boring compliance question, super important but boring, of who's using these products. and creating rules and systems on chain to be able to gate that. But there's also a question of what do we mean when we say a vault, right? The problem is that there's 100 different forms of this that live on chain, each with their own risks and their own trade-offs and technical implementation. And currently people say vault, and they're using this as a sort of way to just bypass like common sense, risk management and security practices. I actually think that vaults we need to form some form of standard around this, and maybe that takes the form of regulation. For what do we mean by a vault? How are these systems fundamentally different than traditional systems? And how do they justify not following the same rules? Maybe even their own form of regulation, right? So this takes the form of what sorts of counterparty risk, what sorts of access controls do these systems have? So that's one thing. I think there's still work to do on that front, and that's the harder problem of creating standards around what we mean by vault. Now, in terms of is this thing actually institutional ready? I think this is a great question. In my opinion, the technology has actually moved faster. It has outpaced the capacity of institutions to be able to offer these products in a compliant way. And this is not a technology problem. This is actually a problem with taking the capabilities of the technology and making them fit with the existing regulations that institutions are beholden to, right? They're not the same as your average DeFi builder who is not worried about the law at all, right? As far as they're concerned, they don't believe in the law in many cases. So I think that's the hard problem, but there's a lot of attention on this, right? Because of the demand from all sides. Users want these products. Fintechs who own these consumer relationships, they want to offer these products to their users. Asset issuers want to distribute their products globally, right? They've done all the hard work of tokenizing these funds, and they want people to use them. So all of the right interests are focused on this, and I think we'll see a lot of progress over the next 6 months with actually making these two worlds more symbiotic.
Super appreciate that perspective. Perhaps now maybe switching gears a little bit to a topic that's near and dear to our heart pretty much every day, and that is liquidity, specifically secondary liquidity. If you are private credit fund manager and issuing, say, $100 million with your quarterly, monthly, even redemptions, how do you assist essentially any of the potential investors willing to get out, rebalance their books? Where do you go for some of that liquidity support? Are we really kind of still building the road as the cars are driving? Or there is maybe already some of the novel solutions that you have thought about or have seen in the market that are trying to ultimately address that secondary liquidity bottleneck? Maybe starting with Victor, since I know you have quite a few assets out there.
So liquidity is always the million-dollar question for private markets because the reason why private markets have been doing relatively better, depending on what metrics you use, or most of the times we outperform, is because the whole point of saying private is because you don't need that liquidity, right? You don't have to. You don't deal with short sellers. You don't deal with Michal, for example. If you own my company and my company is on the next earnings call goes 3 times. You're not going to keep it because you believe in me. You're going to short it because you need liquidity, right? And this is the governance. There's beauty on the governance structure and why you need a manager on privately owned companies. And there's a reason why 90% of companies out there with 100 million worth of revenue are private and not public. I think staying private and being able to focus is a great virtue for entrepreneurs. Having said that, as we have more retail, and this shouldn't be an elitist asset class, it should be available for everybody, just like, why are listed companies available but not the unlisted? It's a matter of structuring, right? It's the same company, and they could be doing very well, but listed companies may get better ratings when their bonds are issued, and companies with better debt coverage ratios, they get lower by virtue of being private. Now, blockchain could be an element in where if everybody accepts law is code and not code is law, and we have market participants coming in. I mean, it's not like liquidity doesn't exist in private market. It exists, but it's just very limited. But if we can get more participants coming in, right, in a compliant way, I think this could open up a new chapter. Just like ETFs, it's a private ETF. It will open up a new chapter where retail people, they need an option to cash out. and this is every day we are trying to ask this question: how should we do this? Should it be on a bid-ask? Should it be on NAV? But you have 40 Act funds, evergreen funds that provide that liquidity, and it's working well. But you can also see that it could be a double-edged sword, right? So we're very measured and composed when it comes to what are the benefits. But I think it's a trend that no one can, decide not to. Every computer engineer and blockchain maxi, they come to me. The first question is, how can I, market making and liquidity? I just tell them, look, give me a good primary first. You cannot mortgage a house if you don't have a house. You cannot trade something when you don't have anything to trade. The primary market needs to get bigger, and then there's a big enough of a market to trade. So it's a secondary question, like secondary liquidity comes after primary. Primary markets needs to be more available primary first, and the access is more important for us for now, but liquidity is always something that will come immediately right after. And blockchain could, like peer-to-peer and participants could really change the equation completely, even without blockchain, but blockchain would just make it more atomic and available.
Tim, Sun, any perspective from kind of the Vault infra?
So secondary market liquidity, I think, is what you're asking about. Primary market liquidity is my problem. And that's why I require the asset sponsor originator to come in with the capital. Because if you're already running 40 million in trade receivables monthly, you just divert 4 million into the vault. You don't change anything. Yes, you have to pay a little bit, but so secondary market liquidity, the answer for that was I thought two things, because I had done time in an ATS years ago. And I said, I can wait until ATSs actually have liquidity, or I can actually just issue short-term paper that self-liquidates in 90 or 180 days. And we decided to do the latter so that we can be in business. And then when we can find secondary market liquidity, we're probably going to go through a secondaries-like route where it's a buyer who knows there's someone who will buy it back, and they're going to get their VIG for providing that earlier liquidity. And we also have spec'd out pathways for some of the vault tokens to trade on prospectively InvestX. So choice, where our job is to provide choice. But liquidity is the biggest problem out there now. One other comment about that. Institutions don't allocate by going to the retail mall, okay? Retail investors do. So I don't see too many institutions just hanging out with their USDC on a network looking for my products. It starts with a conversation, and then they get interested, and then they actually want to be the sponsors of the vault so they can get the VIG.
Yeah, I think you have to work backwards from the demand for these products. And it's very clear there's a mismatch now between things like private credit funds that have like quarterly liquidity and who's actually holding these tokenized products today, right? It's almost a non sequitur, right? And you actually, if you do a profiling of the various RWAs that exist, the ones that are most successful have created a lot of exchange liquidity, DEX liquidity, so that people can come in and out. And they've structured liquidity around the product to be able to get around these sort of monthly or quarterly cycles. You can almost plot it and see the more liquidity that exists for these products, the more adoption. I think that is a function of the user, right? Like, that's not to say there aren't people out there in the world who are happy to lock their capital up for a quarter. It's just that those aren't the users who are currently able to access these products or may not even know that these products exist. What's uniquely powerful about DeFi is, going back to permissionless, right? This ability to take a large number of counterparties all over the world and allow them to come together in a peer-to-peer way is really, really powerful, right? Much stronger than the effects you get in TradFi if this is done properly. So I think the ability to create liquidity around these products is actually much greater on-chain with tokenized assets. We haven't seen that yet because it's still very young and immature, but if you just think from first principles, get everyone who might have exposure to this product, create a pool for them, and they can transact peer-to-peer, it's much better than what you see in TradFi.
Thank you. Well, we have just under 2 minutes left here, so I think wanted to maybe wrap up the panel asking each and every one of you for your essentially kind of honest take, looking out kind of 3 years out, and maybe just focus on, what it will take, just kind of one important element for this to ultimately become a $1 trillion asset class, and maybe what are one of the potential setbacks that could set it back materially, starting maybe with Victor and then finish.
So, I mean, setbacks can always be a setback, and the opportunity is always how the regulatory clarity is always the major element. But I do see the interpretation and the usage of stablecoins, because payments and stablecoin feed tokenization. You cannot have a cash leg. If you don't have cash, you cannot buy anything, right? So if stablecoins go at this speed and they become exponential and more accepted by the traditional financial institution, which is the case today. I mean, you have Fidelity also issuing their own stablecoin, and by legal definitions, those are crypto. That will be the convergence, and this will be where everybody would participate in the use of this, and all of the DeFi techniques will be, unlocked.
I'll make just two concrete predictions. The first is that we will see regulatory clarity for vaults very soon, in maybe 6 months and maybe 12 months, but regulators are already thinking about this category. It's on their radar. Paul Atkins tweeted about vaults like a month and a half ago. We've been engaging with regulators very, very often. And so it's just too big, it's too important. The regulators understand this technology, or they're getting smarter. So I think we're going to see a lot of progress there. The second is that I think this union between fintech and traditional asset managers and RWAs is going to be really, really powerful, right? The fintechs are the ones who have users that really need these products, who don't have access to traditional banking infrastructure, who don't have access to assets. And asset managers recognize this, right? It's a really, really powerful way to get their tokenized funds into the hands of some of the best users for these products. That's going to happen very quickly. In my view, in the next 6 months, we'll see many, many fintechs adopting RWAs to offer yield to their users.
I see this as a continuum of infrastructure change that, like many, many good things in life, starts very slowly and ends quickly. 60 years ago, we dematerialized all physical securities, stock certificates, because we couldn't trade them 5 days a week anymore. We closed the New York Stock Exchange from June to August in 1968. Does everyone remember that? No. So if that hadn't happened, we wouldn't get to this point. I don't see this as an asset class. I see this as all assets will be on chain because they're going to operate better. They're going to be more efficiently, and you don't need to hear it. You all say it every day. So it's a continuum. And I would think that on the 60th anniversary, which should be 2028, we're going to be a lot further there than we ever thought. And then it's going to be a lot of cleanup of everyone else just kind of catching up. So it works.
And on that note, I wanted to thank once again Victor, Sun, Tim. Wonderful discussion. And I'm sure panelists will stick around right after if you want to catch up. But thank you again.
Thank you.
Enjoy the rest of the conference.